Bennett Stewart here to discuss the EVA ratio metrics and how they feature in our software tools. For many years, EVA was simply a profit performance measure. It was defined as NOPAT, or net operating profit after taxes, less a single overall cost of capital charge. Trouble was, operating people found that hard to understand. It was difficult to connect EVA to the familiar ratio metrics they used to run their businesses. CFOs were frustrated they could not compare it across divisions or over time, or use EVA to benchmark with peers or set targets. Boards, too, wanted statistics to judge EVA and set compensation targets, but none existed. Now we've fixed that. Our software models compute the two key EVA ratio metrics that are needed to run, analyze, benchmark, and value any business. Those are EVA margin and EVA momentum. EVA margin is the ratio of EVA to sales. It's the key net profit measure of business model productivity and profitability after covering all operating costs and capital costs. It is our candidate to replace ROI with something simpler and better. It also is a statistic. It ranges from 2.5% to 6% to 12% for the median 75th and 90th percentile companies in the S&P 500, for example. Put simply, a margin over 10% is exceptional. Over 5% is very good, and 2% is decent, a minimum threshold. It's got to be at least that large to turn sales growth into EVA. EVA momentum is the change in EVA divided by prior period sales. In other words, it's an EVA growth rate scaled to the sales size of the business, and it too is a statistic with norms and tendencies. Over 5-year moving windows, it averages about 0.4% a year for the median S&P 500 firm, 1.5% a year at the 75th percentile, and 3 to 4% a year for the 90th percentile. It's also the most important ratio in business because the bigger it is, the bigger EVA is, and the more value a business or business plan is generating. It is the ratio metric to maximize over time and across all lines of business. Understanding it and driving it are the real keys to delivering superior financial performance, which is why our software is chock full of reports that compute and analyze EVA momentum so you can understand how to increase it. Let's start, though, with the EVA margin schedule you see here because it is a component of EVA momentum. Here, EVA is derived from a fully loaded P&L that merges capital costs right into the income statement. It starts with EBITDA. That's the familiar EBITDA, but adding back rent expense, R&D and ad spending, and the reported retirement cost less the service cost, along with other adjustments. It is a better, purer, and more comparable measure of the true cash operating profits that a business is generating. Next up are individual line item charges for capital components like working capital, plant investments, including the rented assets, and intangibles like R&D and ad spending that are being written off over time, where each charge is effectively a rental charge. It is a combination of a pre-tax cost of capital interest charge and the depreciation and amortization of the wasting assets that must be recouped from the cash flow. These culminate in pre-tax EVA, which should command the attention of line management teams. It's what they can control. It combines product pricing power, purchasing power, yield, overhead, logistics and supply chain, plant utilization, and the management of intangible assets into an encompassing net profit margin score. In this example, Merck's EBITDA is a whopping 59.5% of sales. But that is almost fully countered by an overall capital rental charge of 54.5% of sales, the bulk of which comes from writing off R&D over 10 years, which is the default assumption for pharma companies. It's 5 years for most other companies, incidentally. Charges for working capital and for plant and equipment assets also are deducted and also are important. This leaves a pre-tax EVA profit margin of just 5%. This shows how close to the edge most companies operate once capital costs are correctly factored in. In the next section, we account for a set of corporate level items. we deduct a smooth tax figure that has been adjusted for deferred taxes, add miscellaneous non-sales related sources of EVA. This includes equity earnings, credits for non-capital funding, and deductions for unfunded pensions, all of which you can view in detail by drilling down in this schedule. And last, we deduct a charge for really abstract capital, for goodwill premiums and impairment and restructuring charges that have been capitalized instead of deducted from earnings. It all ties out to EVA computed the conventional way, as NOPAT less a capital charge, but this shows the ingredients behind it, which makes EVA easier to understand and manage. Our clients really like this schedule because it simplifies management. It consolidates all the P&L and balance sheet productivity levers into a single schedule of economic profit and loss. In fact, the EVA P&L and margin schedules in the software do the job so well, there are many reasons why you should use them and abandon ROI analysis. The most basic reason is that with EVA, capital is just an understandable interest charge to profit and to profit margin like any other operating cost, just like cost of goods sold. It is not a divisor in a ratio, and there's no multiplication of margins times turns. All that ROI unwieldiness is gone. There is just a simple statement of economic profit and loss. The math is simple, just plus and minus. Capital also is divided into distinct buckets and separately priced. And those costs, in fact, all the productivity levers are expressed on a common percent of sales scale, which is really helpful. Ask yourself, is it more valuable to increase gross margin by 50 basis points or to take 20 days out of working capital? Hard to tell, isn't it? But here it's easy because all the P&L and balance sheet costs are common sized to a common scale. It is easy to see that the money Merck has tied up in its working capital is reducing its pre-tax margin by 2.7%, and that if Merck cut its working capital days by 1/3, let's say, that would add the equivalent of 0.9% to its profit margin. Now everyone can understand its importance. No longer must managers engage in mental FX transactions in order to size up the significance of various drivers or make trade-off calls or to follow trends or benchmark with peers. All those essential analysis tasks are far easier and more obvious. They're also more accurate and reliable. The EVA schedule eliminates accounting distortions in ways that ROI typically fails to address. R&D is treated as an investment. Taxes are smooth. Restructuring charges are capitalized and so forth. There's more insight and there's more confidence because there's more accuracy and consistency. The schedule also presents a number of new and important ratio indicators like the EBITDA cash operating margin, the overall capital charge, and most significant, the pre-tax EVA margin. These are available as key summary statistics to review, to benchmark, and to target. Unlike ROI, EVA margin does not stand on its own. It's part of a bigger story. It ties to EVA and helps managers to increase it. They can think of EVA as sales times the EVA to sales profit margin. It's a familiar sales-based, margin-based way to think about managing a business and adding value. And that tells them they can add EVA and create value in two fundamental ways. First, by increasing the EVA margin, and second, by adding sales at a positive EVA margin. Margin enters right into and defines the value of growth in a way that's completely off the table for ROI. You will see this very clearly on the EVA momentum schedule. I've switched to Amazon just to give you another example. It shows that Amazon's EVA increased from about 1.3 to 4.5 billion, or by about $3.2 billion over the past 5 years on a $40 billion sales base 5 years back. Run the ratio, and that's an overall momentum rate of 7.9%, or an average of about 1.6% a year, which is quite good, upper quartile, as is reported on the schedule. Now let's unveil the two sources that always add up to momentum for any company. The first, at left, are the productivity gains from engineering an increase in the EVA profit margin. That gives management the full margin schedule to work with to drop more EVA profit to the bottom line out of top-line sales. Amazon's EVA margin increased only from 3.2% to 3.7%, just a 0.5% over 5 years, or 0.1% per annum. Taken alone, that would produce a paltry momentum score well under the median S&P 500 value. But it's only half, or in this case, a lot less than half the story. Management can also add EVA and add value by adding sales at positive EVA margins, which is something Amazon did in spades. It added 200% to its sales, and the sales it added to EVA the 3.7% margin rate. Multiply those two together, and that produced almost all the momentum and all the added value, and yet that is an accomplishment that a measure like ROI completely ignores. By the way, our software can zoom in on quarters. This one shows Amazon's momentum accelerating. It's up to a run rate of 2% a year in the most recent quarter as investments in cloud computing and scaling distribution are really starting to pay off. As this illustrates, EVA momentum is the very best turning point indicator because it brings all the pressure points and positive developments to bear. For a more complete view, EVA margin tucks in under the EVA momentum schedule and is shown here with more details exposed. In practice, our clients go even deeper and we automate schedules to bring company-specific metrics onto the EVA momentum scorecard. Here, though, we can see that Amazon's gross margin expanded significantly, but we can also see that overstates the gain. The company's true SG&A costs, net of depreciation and rent and R&D and advertising costs, which we've put aside, increased. Selling cloud computing is a more expensive proposition than internet fulfillment. More significantly, the intensity of the plant-based increased 2.5-fold. There's now a lot more money in distribution centers and data centers compared to sales than before, and those assets are being depreciated and must be replaced more rapidly than before. The overall PP&E, property, plant, and equipment rental charge almost tripled from 3.5% to 9.2% of sales. But that's not bad per se. That's just a necessary cost of expanding the gross margin and driving the sales growth. It's only EVA momentum that matters in the end, and that's been exceptionally good. The explosion in plant capital had another consequence, by the way. It precipitated a material reduction in Amazon's ROI. How is it possible that the company's EVA margin relative to sales went up, but EVA relative to capital went down? Simple. The ratio of capital to sales increased a lot. So much so, it turned an increase in EVA to sales into a decrease relative to capital. So while ROI suggests there has been a degradation in business model productivity, that's only because productivity is being measured relative to capital. But when capital is just treated as a cost rather than as an index, the business model productivity is doing quite well, thank you. In the end, ROI misses the boat twice. It goes down when the net economic profit margin goes up, and it completely ignores the value of the growth, which EVA and EVA momentum clearly register. Amazon's EVA also looks much better than its reported net income or earnings per share. And a big reason is that Amazon stepped up its R&D spending a lot, from 5.6% of sales to 11.8%, from $2.2 billion to $14 billion a year over the past 5 years, all of which was immediately deducted from its book profits. But in EVA, R&D was written off over 5 years, pushing the cost forward into subsequent periods when sales were much higher, so that even after including a capital charge on the R&D balance, the annualized cost only increased from 3.5% to 7.4%. That's 4.4% lower than the book cost and a much more accurate and matched measure of the true burden. There's a similar effect for ad spending. The bottom line is, Amazon's EVA and EVA momentum remained in the black, on the rise and right on track with Amazon's superlative stock price performance over the past 5 years, whereas EPS, ROI, and cash flow did not. So let me sum up by saying that the EVA margin schedule is a clearly superior and simpler way to analyze, benchmark, and improve business model productivity, and that EVA momentum should be every company's most important planning goal and planning diagnostic tool, as well as the focal point of quarter-to-quarter management reviews. These two key EVA ratio metrics also feature in two of our most advanced applications, CPI, the Corporate Performance Index of Financial Excellence, and Improve It, the EVA-based stock rating system. In these, we statistically rate the EVA ratio metrics against broad sets of public companies. They are big data tools in the EVA world to derive incredibly valuable insights about financial performance and intrinsic value. I encourage you to learn more about those too. Thank you for listening.